Gautam Duggad, the head of research institutional equities at Motilal Oswal Financial Services, joins us now to talk about his expectations. Gautam, hi, good morning. And as always, it's great seeing you, especially on a big day like today. And I must say, it is an exciting budget to watch out for, right? I mean, this is a government that has come back to power for the third straight term. So everyone's interested to see what aces they have up their sleeve. What do you think could move the needle of the market today?
Hi, Sonia. Good morning. Thanks for having me. So, yes, it's a big day, and this is the first budget of a new government. So, market will be very keenly awaiting the policy signals, what priorities they point out, not just for the remaining 6 months, because in another 6 months we will have the next full budget for FY26. But what policy agenda they lay out for the third term of this government? Where are the focus areas? We have seen for last 10 years now that CapEx, infrastructure investments, PLI, manufacturing, that has been the broad architecture under which this government operated. And of course, fiscal conservatism, because the quality of the balance sheet management by this government has been excellent. As we move forward, I think this government in this particular year has an extra firepower of about 1.5 lakh crore. So how do they use it for welfare spending? Do they use it to revive the bottom of the pyramid consumption, offer some freebies or tax concession? That is a new element which has come in. I think that's largely a reflection of the mandate that this government has got, where now we have a coalition government in place. So that is the second element that one would watch out for. And third, of course, how's the overall balance sheet numbers stack up, whether they go for 5.1, 5, 4.1, that's a matter of semantics. But as long as the fiscal deficit stays within a range, the overall macro sentiment of India, which has improved significantly, because if you look at the current account, the stable currency, the rising forex reserves, and overall growth, so both macro and micro are in a perfect combination. What one wouldn't want to see, obviously, is any negatives on taxation. So that's broadly three elements on which at least I would be looking for.
Okay, I take your point, Gautam, but if you read the economic survey, there are large chunks of fears of over-financialization and, markets getting too exuberant. That's very much there in several paragraphs. So let us assume, for argument's sake, capital gains is not touched, but F&O gains are defined as speculative. I mean, some people are saying that that's a possibility. How will the market react?
I think obviously there will be some knee-jerk, but it is not something which is unexpected completely, because a lot of regulators, whether it is SEBI, whether it is RBI, and now of course the government in its economic surveys, have been pointing out about the excesses in F&O, and they've been cautioning the investors, specifically the retail investors, which come in with a big surge, because you look at the way the entire demat accounts in India have gone up from 3.5 crores in March 20 to almost 16 crore now in 4 years. Of course, a lot of it is also for investments, mutual funds and SIPs, etc., etc. But clearly the F&O volume, especially in the last 2 years, have taken a huge surge. So while it is difficult to say what exactly they will be doing, but some measures are widely expected to come, and that's been an expectation for 3-4 months now. So let's see what actually happens. We'll see what they do, whether it is in the realm of short term or are there any measures from a long term point of view. So very difficult to say before one actually goes through it.
Gautam, hi, morning. I know it's not just one day, but today is that one day. So in terms of sectors, Gautam, which you perhaps could see incremental boost, are you watching anything specific? I mean, housing is being talked about, and what other things, 2 or 3 top ideas?
Sure, Prashant, good morning. So I think last 8-10 years we have got accustomed to watching manufacturing, housing, capex and infra sectors in this government regime. Today, for a change, I would be looking at consumer sector, because that is where expectations are changing a bit as far as policy is concerned. Whether they provide some tax relief, whether they increase the budget for Manrega substantially, or whether there are some other handouts, whether increase in PM Kisan installment for the farmers from 6,000 to whatever 8,000-9,000. So some of those things are going to be new because we are not used to seeing this. In fact, if you remember the February interim budget, I don't recall any instance in the past when in an election year the government has budgeted only 3% increase in a revenue expenditure. So if my numbers are correct, I think they had budgeted 3.2% increase in FY25 budget estimates, which they presented on 1st February. So we'll have to see whether there is a realignment in the expenditure mix away from capex towards consumption, or the extra bounty that they've got, would they, provide it completely for driving consumption. So that those are the two sectors we will keep a special eye on. In fact, that is a sector where we have increased our weight also recently. And then, of course, the usual things around railways, defense,
That's
roads.
fine. But since you're watching consumption more than investment and capex, etc., what are the 2 or 3 from your published universe? What are the 2 or 3 stocks best levered if there is a boost to consumption, in your opinion?
So Prashant, the names are not too different. Actually, we've just put in Hindustan Lever and Godrej Consumer in our model portfolio. In fact, in April, we had put out a thematic report on consumer staples where we had turned positive on it after 2.5 years. Obviously, the logic was that we are going to get a normal monsoon. Of course, we didn't anticipate that the mandate will be little more fractured than what we have seen in the past 2 terms. But yes, post 4 June, the expectations about government policy focus shifting incrementally towards supporting consumption, because we have 3 big elections in October, November, Maharashtra, Jharkhand and Haryana. So those expectations have got well entrenched now. So with that in mind, we had tactically changed our call on consumer staples in April. And in the model portfolio revision that we just did 2 weeks back, we had introduced Lever and GCPL back in our model portfolio. Overall view on consumption is still tilted more towards discretionary. If you look at our model portfolio, we have 20% allocation towards consumption, out of which 15% is in discretionary and just 4 or 5 in staples. And yes, another sector which could potentially benefit if there are measures for consumption is obviously going to be auto, 2-wheelers, and maybe at the margin 4-wheelers too. But all of that providing, assuming that there are no incremental changes in taxes.
Gautam, you told us what you are going heavy on before, or what you guys like before you get into the budget or in the last few weeks. What would you avoid? I mean, I'm just looking at all these rail stocks and PSU stocks. It's crazy, 200%, 300% over the past year. Are there any avoids, even if it is a capex heavy budget?
So, Lata, you asked a very important question. Even if it's a capex heavy budget, you have to figure out which elements of the capex there is still risk reward which is left in favor of the investors. To buttress your point on railways, and may I add defense also, we just put out a data a week back. I think Anuj did a program on that in his editors roundtable 2 last week, where we just pointed out that in the last 3 years, defense market cap in India, all the listed companies, has gone from 1 lakh crore to 11 lakh crores from March 21 to July 24. So that's an 11x jump. Similarly, for railways in the same period, the market cap of all listed railway stocks have gone from 1 lakh crore to 7 lakh crores. So cumulatively, these 2 spaces have gone from 2 lakh to 18 lakh crore market cap, which is a 9x jump in 3 years. And profits have gone from 15,000 crores to 30,000 crores, which takes your trailing price to earnings multiple from 12x or rather 15x to about 60x. So clearly, a lot of the buoyancy which is expected in the business in those 2 sectors is already reflecting in the underlying market cap and stock prices. So one has to be extremely, extremely cautious if at all one wants to invest in those spaces. Otherwise, you can stay away from those spaces because the risk reward is clearly not in your favor. If you look at the markets broadly, Lata, large caps still look very okayish in terms of valuations. We are still trading at 20 times 1 year forward for Nifty, which is in line with 10-year average. I get the point that ex-financials, the market is slightly expensive because the last 5 years, earnings have compounded at 18% for Nifty, and market cap has also compounded 18%. But if you strip aside financials, you have a 13% compounding in earnings and 19% in market cap. The real problem still lies in mid and small caps, where the re-rating has been crazy. If you look at the same data for mid cap, with a 17% earnings compounding, you've got a 27% market cap compounding. So it's a 60% premium out there, and that is where you have to be very, very mindful of what you're buying.
That statistic, the first time you told me, is stunning, Gautam, right? 2 lakh crore market cap has become 18 lakh crore market cap in two sectors, rail and defense, right? That is the kind of increase in market cap. So I would be, okay if I say, Gautam, for the budget itself to be a big driver, right, for these sectors. I mean, it's going to take a lot incrementally because prices move on incremental news. Would that be right, Gautam?
And that's a fair assessment, Prashant. But budget is a one event. We obviously get very excited around this event every year.
Today's
on 1st of
budget,
February,
yeah.
And then we realize by 3rd of the February that budget is a history.
Yeah, correct.
Unless there is some big negative, and I think this time it will not be any different.
Yeah.
Unless you get a very big negative in the budget, people will forget this budget in the next 2 days,
Yeah.
and focus will back be on fundamentals and earnings, and that is where the real problem is in some of the spaces which are trading at 60p, but earnings are growing at 10-12%.
Okay.
So I think focus will turn back to the fundamentals in another 2 days, unless you see some major negative announcement in budget.
And hopefully we won't see that, especially taxation, as you also mentioned. Gautam, thanks very much for joining us. Great speaking with you here on CNBC-TV18, and hope to speak with you once again after the budget is out.